Insurance and the roles of insurance as a risk management strategy. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses insurance and the roles of insurance as a risk management strategy, with a practical case study. In this video, we described insurance and explained functions of insurance, benefits of insurance and how insurance operates, features of insurable risks, how insurers cope with adverse selection, differences between traditional insurance contracts and loss-sensitive insurance contracts, and the roles of insurance in risk management. Now, let us start. What is an insurance contract? A contract is a legally binding agreement between two or more parties whereby rights are acquired by one or more parties to act or forbearances on the part of the other. Insurance is a contract between two parties, the insured and the insurer, whereby the insurer undertakes to make good a loss of the insured caused by specified perils during the period of the contract in exchange for a consideration known as the premium. Insurance is the pooling of fortuitous losses by transferring of such risks to insurers, who agree to indemnify insureds for such losses, to provide other pecuniary benefits on their occurrence, or to render services connected with the risk. Insurance policies can be purchased by individuals, households, and businesses to manage their risk exposures. Hence, insurance may be considered as the custodian or treasurer of the fund. All risks proposed are assessed by the insurer to ensure that all insureds should pay a commensurate premium, and appropriate terms and conditions are included in insurance policies issued to the insureds. Functions of insurance. Here are the basic functions of insurance. 1. Risk transfer. Insurance is a risk transfer mechanism through which individuals or business enterprises can shift some of the uncertainty of life onto the shoulders of others, that is, insurers, in return for premium payment. 2. Common pool. Insurance spreads the financial losses of insured members over the whole of the insuring community, by compensating the unfortunate few from the fund built up from the contribution of all members. 3. Security. Insurance creates confidence knowing fully well those losses attributable to fire or other insurable risks which may cripple business activities have been adequately insured accordingly. 4. Investment enhancement. The insuring public contribution, premium, may be invested in production activities thereby facilitating an increase in the available fund by way of resultant interest from such investment. 5. Loss control, prevention, and reduction. Insurance improves loss control, prevention and reduction through policy wordings, and trained experts, and the enlightenment of the insuring public. 6. Savings. Life insurance is a means of saving. This may be arranged for saving towards certain purposes as the saver is more inclined to keep on paying the premium, compared with saving in a bank or building society. Benefits of insurance. Benefits of insurance include 1. Payment of loss, provides compensation or indemnity as may be necessary. 2. Reduction of uncertainty by covering possible loss exposures. 3. Ensures compliance with the legal requirement, statutory and contractual requirements. 4. Promotes loss control activity. 5. Efficient use of insured's financial resources, after premium payment, and 6. Reduces social burden through compensation of insured accident victims. Insurable risks. Not all risks can be insured by insurance companies or insurers. Risks that can be transferred to or insured with insurers are known as insurable risks, while risks that cannot be transferred to or insured by insurers are known as uninsurable risks. Insurable risks must possess the features or characteristics of insurable risks. Features of insurable risks. The following are the features of insurable risks. 1. Financial value. The expected loss must be financially calculable, that is, the pecuniary value, sentimental value. In several cases, the financial value of the risk would not be known before the event occurs, but the loss, when it occurs, must be capable of being measured financially. To some extent, life assurance is a modification of this general rule, in that life cannot be measured precisely in financial terms. 2. Insurable interest. The insured must have an insurable interest in the event or risk insured. Insurable interest basically means that the person seeking the insurance must be legally entitled to insure the item or event. If the insured does not have an insurable interest, any insurance so arranged is void and has no legal effect. Insurable interest is one of the basic principles of insurance to protect the financial interest of the insured in the subject matter of insurance. 3. Fortuitous. The loss should be fortuitous or accidental in nature. The loss must be entirely fortuitous as far as the person seeking insurance is concerned. For there to be an insurable risk, there must be an uncertainty of loss, and losses must be reasonably unexpected, accidental. 4. Homogeneous exposure. There must be a large number of homogeneous or similar risk exposures. Insurance is subject to the law of a large number of similar risks, and this works based on pooling of the fund, premium, of participants out of which the few unfortunate are compensated. 5. Losses must not be catastrophic in nature. Many insurable risks tend to be pure risks. Very large risks may be insured, but some risks are of such magnitude that insurance funds, at least on a commercial scale, would be quite inadequate. Therefore, with certain exceptions, it is usual to find a standard exclusion regarding war risks and radioactivity contamination in all insurance contracts. 6. Not against the public policy. The insurance must not be against public policy or the law. It is a common law principle in law that contract must not be contrary to what society considers the right and moral thing to do. Providing insurance that is against public policy would amount to encouraging unlawful and depriving the authority of their right to punish wrongdoers. 7. Particular and fundamental risks. Particular risks are generally insurable provided they satisfy the other criteria of insurable risks. This is because they are risks, the consequences of which are comparatively restricted, and likely to result in a loss for individuals should they occur. Fundamental risks are risks that tend to affect large sections of the society or the world at large, rather than individuals, and it is catastrophic in nature. 8. Reasonable premium. The premium payable should be reasonable. Insurers undertake to insure insuring public risks in exchange for a premium, which is the consideration of the contract. The premium must be seen to be reasonable in relation to the likely financial loss. How does insurance operate? Insurance operates based on 4 key ingredients. 1. Risk transfer. This extends to reinsurance and retrocession contracts. 2. Creation of common pools, laws of large numbers. 3. Charging of equitable premiums, and 4. Avoidance of adverse selection. Adverse selection against insurers. Adverse selection is the tendency of persons with a higher than average chance of loss to seek insurance at standard, average, rates, which if not controlled by underwriting, results in higher than expected loss levels. How do insurers cope with adverse selection? Methods of dealing with adverse selection by insurers include, 1. Seeking information disclosure, 2. Selecting a niche market or class of insurance. 3. Prudent underwriting, and 4. Effective use of insurance policy conditions. Legal principles of insurance. The nature of legal principles of insurance varies from country to country, but essential legal principles of insurance are utmost good faith, insurable interest, indemnity, subrogation, contribution, and proximate cause. Now, let us briefly examine the legal principles of insurance. Utmost good faith. The Latin maxim for utmost good faith is uberrima fidei. Utmost good faith is an insurance principle that emphasizes that both parties to an insurance contract have an obligation to disclose facts that are material to the risk, even if specific questions are not asked. Facts that are material to risk are known as material facts. According to Section 18(2) of Marine Insurance Act 1906, a material fact is every circumstance which would influence the judgment of a prudent and reasonable underwriter in fixing a premium or determining whether to accept the risk. Examples of facts that need to be disclosed by proposers, that is, material facts: 1. Circumstances that suggest the risk is greater than the norm. 2. Circumstances that would increase the possibility of loss. 3. Previous claims or losses. 4. The existence of other policies. 5. Circumstances that reduce an insurer's subrogation rights. And 6. Information relating to, and descriptions of, the subject matter of the insurance. Modification of duty of disclosure on the part of insurers. Both parties, that is, the insured and the insurer, to an insurance contract are obliged to disclose material information or material facts to each other. This is known as the duty of disclosure. The duty of disclosure of the insured is rather clear and straightforward. However, some people thought that the onus of the duty of disclosure lies only on the insureds, not on insurers. This is not correct, as the onus of the duty of disclosure lies on both the insured and the insurer to disclose a material fact and act in good faith in an insurance contract. In most parts of the world, the duty of disclosure has been modified. Generally, the modification of duty of disclosure emphasized that a proposal form for insurance should be prepared in such a manner as to elicit material information required by the insurer to determine the acceptance of the proposed risk, and the proposal form should be printed in easily readable letters. Examples of facts that would not need to be disclosed, that is, immaterial facts. 1. Facts that improve the risk. 2. Facts of common knowledge, including facts of law. 3. Facts that lessen levels of risk. 4. Facts which the insurer could glean from already disclosed information or from a completed survey. 5. Facts that are reasonably unknown to the insured, and 6. Spent convictions. Insurable interest. Insurable interest constitutes a legal right to insure. This means that anyone who insures must have a legal/financial interest in the subject matter of insurance, that is, what is being insured. Insurable interest was initially introduced to distinguish insurance from gambling. Depending on the type of insurance, the insurable interest must occur at either the time of taking out the insurance or the time of any loss. When does insurable interest arise? 1. Life insurance. For life insurance, the insured must have an insurable interest at the inception of the insurance. 2. Marine insurance. For marine insurance, the insured does not need to have an insurable interest at the inception of the insurance, but the insured must have an insurable interest at the time of the loss. 3. All other insurances, other than life and marine insurances, the insured must have an insurable interest at both the inception of the insurance contract and at the time of loss. Indemnity. Insurance policies should only pay for the extent of financial loss which has occurred, that is, you cannot make a profit out of an insurance claim at the detriment of the insurance company. Life insurance, accident, and sickness insurances are not indemnity contracts, but they are benefit contracts. Indemnity can be provided through cash payment, repair, replacement, and reinstatement. However, the method used is at the discretion of the insurance company, and there will generally be limits on an indemnity, that is, the maximum liability. Subrogation. Subrogation is the right that your insurance company has to recover any money that it has paid to you from another party. Both subrogation and contribution are corollaries of indemnity. The two principles, that is, subrogation and contribution, are applicable to indemnity insurance contracts, but these principles are not applicable to benefit insurance contracts. Contribution. The principle of contribution is aimed at ensuring that all insurance covering a risk pays a rateable proportion of every loss. Hence, if an individual or firm has more than one insurance policy covering a loss, a total loss claim cannot be lodged with all the insurers. All the policies must contribute proportionately to the total cost of the loss. Proximate cause. Proximate cause has been defined in the case of Pawsey v. Scottish Union and National 1907 as, the active efficient cause that sets in motion a train of events which brings about a result without the intervention of any force started and working actively from a new and independent source. What is peril? Peril is a loss-causing event, such as fire, theft, flood, and explosion. The following three types of perils may cause a loss or losses. 1. Insured peril is an event or loss expressly stated as covered and insured on the insurance policy document. 2. Excluded peril is an event or loss expressly excluded, that is, not covered by the insurance policy. 3. Uninsured peril is an event or loss not stated or mentioned in an insurance policy. An insurer can pay for a loss caused by an uninsured peril, provided such an event is an action aimed at reducing the extent of a loss. Each occurring in isolation generally causes no problem. However, combinations of perils may be extremely complex and problematic. For instance, insurers would pay for losses caused by insured perils and uninsured peril geared towards minimizing a loss. Insurers are, however, not obliged to pay for losses caused by accepted perils and uninsured peril which aggravate a loss. The proximate cause can become very complicated when there is a chain of events leading to a loss and may need to be resolved by a court of competent jurisdiction. Businesses can purchase two major kinds of insurance policies to manage their risks: 1. Traditional insurance contracts, and 2. Loss-sensitive insurance contracts. Traditional insurance contracts. Traditional insurance contracts are insurance contracts whose premiums depend on the value at risk and feature of the subject matter insured, that is, the item or risk insured, at the inception of the insurance contract. Loss-sensitive insurance contracts are insurance contracts whose premiums depend on the loss experienced by the policy. Now, let us discuss these types of insurances. Examples of traditional insurance contracts include fire insurance, theft insurance, money insurance, credit insurance, business interruption insurance, contractors' all-risk insurance, goods in transit insurance, engineering insurance, motor insurance, marine insurance, aviation insurance, public liability insurance, product liability insurance, professional indemnity insurance, employers' liability insurance, directors' and officers' liability, contingency insurance, life insurance, sickness, and accident insurance. Classes of traditional insurance policies. Fire insurance policy. Standard fire policy was traditionally designed to cover buildings, plant machinery, and stocks against fire, lightning and certain types of an explosion. Additional perils are now added to fire insurance in response to customer needs. Fire and special perils insurance can be purchased by businesses to cover their fire risk exposure. Theft insurance policy. Theft insurance covers theft accomplished with forcible entry and exit from premises. Money insurance covers physical loss or damage to cash and negotiable instruments, for example, checks and money orders, on premises and in transit, including theft but excluding theft by employees. Credit insurance covers a firm against non-payment for goods and services supplied or sold on credit. Business interruption insurance, also known as loss of profit or consequential losses, indemnifies the insured against business disruption arising from an insured peril. Cover includes loss of gross profit, wages, additional costs of working, and the cover is usually for 12, 24, and 36 months. Contractors' all-risk insurance. Usually issued on an all-risks basis to provide indemnity against any cause except war and civil commotion, consequential loss, cessation of work, defective design, defective material or workmanship, breakdown of a plant, and lack of maintenance. Goods in transit insurance covers the owner or carrier of goods for damage or loss incurred during inland transit. Attention is given to the quality of the carrier. Engineering insurance provides indemnity to the insured for loss or damage to plant and machinery. Insurers offer an inspection service with or without insurance coverage. In some countries regular inspection of a plant is statutory and the insurer may be authorized to carry out the inspection. Accident insurance, individual or group, provides compensation for accidental injury or sickness to a named person or persons. Motor insurance, private and commercial, covers liability in respect of road accidents towards third parties and damage to the vehicle itself. Motor insurance cover ranges from comprehensive to ACT covers. Motor trade insurance policy. A motor trade policy is a specialist motor insurance package policy for garages. Covers also the building, showroom, and vehicles. May also cover vehicles under the care of the garage's custody and control. Marine insurance provides cover against the perils of the sea, for example sinking, heavy weather damage, fire, collision, piracy. The cover may include the hull, the cargo, or the freight, payment for the carriage of cargo. Forms of marine insurance can be time, voyage, mixed, construction, floating, and open cover. Aviation insurance covers the hull, passenger liability, and third-party liability, usually on all risks basis. The insurance can be purchased by airlines, individuals, and flying clubs. Liability insurances. Firms may become liable for bodily injury or damage to property caused by their acts or omissions. The liability may arise out of negligence, statute, or contract. The potential for claims to arise often relates to local culture, custom, or predisposition of the legal system to support such actions. There are several liability insurances including employer's liability, public liability, products liability, professional indemnity, directors and officers liability. Public liability insurance covers the liability of a business to the public because of its operation, for example, pollution, injury to a visitor, damage to third-party goods in the custody of the insured. The policy will specify limits of liability offered by the insurer, and a higher limit can be granted on request. Product liability insurance covers liability arising out of goods sold, supplied, repaired, or serviced by the insured. Claims for damages usually fall into four categories: defective design, defective manufacture, defective warnings, and negligent surveillance or lack of safety. Professional indemnity insurance covers negligent acts carried out and advices given as part of a professional service such as lawyers, accountants, and brokers. Employers' liability insurance covers employers' liability to employees for personal injury arising out of their employment activities. This is compulsory in many countries, and sometimes cover goes beyond just negligence and is called workers' compensation. Directors and officers, D&O, liability insurance covers the personal liability of directors for the way in which they run their companies. The policy is essential in view of increasing corporate scandals in the last decade. Directors of all companies are now held, at an unprecedented level, to be personally responsible for any actions and decisions they make on behalf of the company, putting their personal assets at risk if those decisions are tested in the courts. Contingency insurance. This insurance provides miscellaneous covers which are not in the main classes, for example, events and contracts cancellation. Having briefly described traditional insurance policies, let us move on to examine loss-sensitive insurance, which is the second kind of insurance contract. Loss-sensitive insurance contracts. Loss-sensitive insurance contract is an insurance policy whose premiums depend on the loss experienced. Loss-sensitive insurance contract is an insurance rating for which the final premium is dependent on the actual losses during the period the plan is in effect. This risk financing technique places upper limits on the insured's costs if its losses are high, but also requires the payment of a minimum premium in the event it experiences low losses or is loss-free. Hence, the risk and premium of loss-sensitive insurance contracts tend to vary based on the actual loss experience. Loss-sensitive insurance provides an incentive for firms to emphasize safety and loss control activities. With a loss-sensitive structure, a firm pays a lower premium in exchange for partial coverage of a loss in excess of its deductible, and the organization can further reduce the retained costs by improving safety and claims handling procedures. Advantages of loss-sensitive insurance. Advantages of loss-sensitive insurance include lower premiums, savings through loss control and claims handling, improved cash flow, and investment income. price stability, and lower cost of risk. Examples of loss-sensitive plans include deductible plans, retrospective rating plans, dividend plans, and retention plans. A case study on roles of insurance in risk management. Case Study 1, British Petroleum, BP. British Petroleum only buys insurance when they are legally obliged to do so, and, even then, they buy it from a company that they own. It is estimated that British Petroleum only insure 5% of its risk, with AIG through a fronting arrangement. This means that British Petroleum is financing almost all of their risks themselves. To examine the case study, let us focus on the following 3 questions. Question 1, why would British Petroleum insure only 5% of its risks? Question 2, what are the dangers for British Petroleum for insuring only 5% of its risk? Question 3, what are the possible risk financing solutions, other than purchasing insurance? I would suggest that you brainstorm on the case study so as to enhance your knowledge of the way insurance works. Meanwhile, let us now proffer possible answers to these questions. Question 1, why would British Petroleum, BP, do this? In my own opinion, here are some reasons why British Petroleum did that. 1. Buying insurance is very difficult for oil companies of their type. 2. Even if British Petroleum could buy insurance, self-insurance might be more economical. They are only covering their own risks and they are not contributing to insurers and the investors' profits. 3. In a good year, self-insurance and captive will generate a profit which remains with British Petroleum, and 4. There are significant tax and accounting benefits. Question 2, what are the dangers for British Petroleum? In my opinion, potential dangers for British Petroleum include 1. In large losses, the organisation bears the full cost. 2. Financing large losses can lead to underinvestment on other parts of the business. 3. The Gulf of Mexico oil spill may cost $40 billion and, at one time, threaten the survival of British Petroleum, and 4. Environmental damage has what is known as a long-tail potential. Final costs are not known for a very long time. Question 3, what are the possible risk financing solutions for British Petroleum? Possible risk financing solutions for British Petroleum include 1. Large-scale purchase of insurance on the market is highly unlikely. 2. A more detailed review of exposure and the potential cost of risk. 3. Greater use of reinsurance through the captive, and 4. Consider using capital markets, that is, catastrophe bonds and contingent capital. It is worthwhile to emphasize that risk management through capital markets is highly complicated, but not for a company such as British Petroleum. I would encourage you to brainstorm on the case study so as to enhance your knowledge of the way insurance works. Conclusion. In this video, we have considered the roles of insurance as a risk management strategy. Specifically, discussed functions of insurance, benefits of insurance and how insurance operates, features of insurable risks, how insurers cope with adverse selection, differences between traditional insurance contracts and loss-sensitive insurance contracts, and the roles of insurance in risk management. A case study of British Petroleum on the use of insurance was also presented to demonstrate the essence of insurance as a risk management technique. I hope the video is educative and beneficial to you. Please post your response below in the comments section. If this video has been educative and beneficial to you, then, give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.